and also share the screen. All right. Let me try that again. It's not working. Okay, finally. All right, the wealth building process for you to take into consideration for 2025. Of course, as usual, you can find all our backup on our review and our replays on everything on our website, valueinvestasia.com/club. And do note that all these are just my personal opinion. It doesn't represent my employer, which is iFAST Global Market. And please take this as just educational purposes, and I'm just sharing my own experience for you to take as a reference point, and do seek out if you need help to find out more information either from me or your particular financial advisor. Okay, of course, as mentioned just now, I now represent iFAST Global Market, which is a wealth platform that helps you, together with an advisor like myself, to systematically and organize your wealth planning stage, regardless of what is your objective. And the platforms allows us to invest throughout most asset classes, from trusts to bonds to unique managed portfolio that the company can do for you, and also stocks and ETF as well. So things that I do for my clients and also for myself tends to focus on a few key philosophy that I adhere to, which is I'm always looking at the long-term objective. So we are focused on truly building wealth for the long term, of understanding what do you need the wealth or the funds for in the future, and then work backwards to have a system to build towards that target. And I myself focus a lot in risk management when it comes to building my portfolio, and I like to focus a lot on high quality companies and also funds, just to ensure that the stability of the investment is the number one priority, right? And then, of course, I try not to time the market. So over the past close to 20 years now of investing, I've gone through, I think, 5 or 6 market crashes on a year-to-year basis. But over time, we can truly see the results, because most of the time, the stock market tends to recover after a while, or if you face a correction or a crash. And what I'm trying to do here is truly build something what I call an everlasting portfolio, something that we can continue to use the same strategy regardless of how big our size of investment is, right? Be it if you start with just a few $1,000 to when you reach millions and millions of dollars in your funds, we can still continue to use the same strategy going forward. That's what I try to aim for. And for our members on the Learn with Stanley Club, you also can have access to something that I'm building, which is my ETF portfolio as well on the iFAST platform, that you can constantly monitor how's my progress. Okay, but today we're going to be discussing a few things. I'll run through with you some ideas that I have, together with a full review on my portfolio and what are some of the stocks that I'm focusing on, and why I bought them or I have sold them throughout the year, and my thinking process behind it, of how I built a portfolio from scratch. So number one, let's dive into like what I see is the top issue for investors that is really restrict them from creating real long-term wealth, right? Building out real long-term wealth. From that, I want to introduce the idea of continuously monitoring your net worth. How do we calculate that on a yearly basis or a quarterly basis, and measure out how is your wealth being generated, growing over time? And from there, understanding where is the key risk in your financial situation, right? And then that will lead me to talk a little bit more about my portfolio, the review of the portfolio, how it came to be, and my plans for it in the future. And from there, I'll summarize it in what I call the process of wealth building. So step by step, things that I tend to do with my client as well, the step-by-step process that I've gone through with them and for myself on how to look at the wealth building process. Okay, so the number one key issue that I tend to see with a lot of investors when I'm talking to them, or even just friends and families, that when we have discussion and they realize that I'm in the finance life, they tend to, the main questions is always, what stock can buy, right? What are the stocks they can buy now? Or they have heard of stocks that their friends and colleague might be introducing to them, things that the other people has been making money off, and they will ask my opinion for it, hoping that they could also jump into the trend. There's nothing wrong with that. I started out like this as well. I started out in 2006 when I first started investing, mainly also based on stock tips that I can gather online or from anywhere, from my reminders and everything. But very, very fast, what I realized is if we are only acting on tips or information that other people is feeding us, or we see other people is making money on it from some stocks that we might not even be very, very familiar with, and we jump into it, what happened is we tend to want to get involved, but never in a very significant way. So think of it as this pie is your entire wealth, right? If someone give you a stock tip, or you heard of somebody making money in some stocks, or can be crypto or whatever, the fab of the day, most of us is gonna allocate maybe a portion of our wealth within that, another small portion and a small portion, right? Just a small amount of money that we might don't mind losing it all, because we don't have the confidence to really bet big on some of these ideas that just come our way from hearsay. And the issue in the long term is we can never build a significant and meaningful portfolio with that kind of strategy, because we will never be comfortable enough to risk a big amount of money on stocks that we ourselves is not familiar with, or with funds that we ourselves is not familiar with. And so what happens if we can buy something, if we lose money, we blame our luck, we blame our friends for introducing to us, and we say that stocks is not the way for me, I don't want to touch it anymore. Or if we make some right move and we make some money, that's great. It becomes some pocket money for us. We might feel that we are very good at this, and we end up betting bigger and bigger and bigger until the point that we make a mistake again. And then the same conclusion is stock is not for me, I'd rather not touch it, right? And both of that scenario, either you earn money in the first try or lose money in the first try, it all leads back to the point where it's very, very hard for us to build out a portfolio that is truly meaningful in size to make a difference to our entire wealth and to really create passive income for us in the future. So I like to take a little bit different approach, which is, of course, this is also something that is evolved over time, right? I don't start out like this, but the key is once you gain more and more knowledge by yourself, the point is understanding the asset that you want to invest in, be it property, be it stocks, be it funds. It's great if we can work with an advisor, but even with working with someone like myself as an advisor, it's still very important for us as individual to continuously gain more and more knowledge about the things that we invest in. And only through that we understand what we are truly investing in, that we are more comfortable of truly allocating a big part of our asset size into the portfolio. and creating meaningful portfolio that really can make a difference, right? For myself, right now, this is as of I think the end of 2024. Typically, every year I'll try to do something like a balance sheet for my own finances for me and my family, of course, and I like to list down. Later, I can show you the information. But I'll list down everything that I own, and everything, all my liabilities as well, so that I can work out what my net worth is at the end of the day. And I like to track that every year to see that if my net worth is still growing, is still doing well, and I'm on track to meet my financial goals that I've set out to do in the future. And as of today, my entire wealth of all the assets that I have, more than half is actually in stocks, right? This is maybe something that is a little bit more, I guess, peculiar for most people. For our, at least our Asian culture, at the end of the day, we are still very much more comfortable with property investment. But just for me and myself and maybe my experience with stocks, and also my not so good experience with investment property, I tend to be more comfortable owning stocks over the long term. And this is allocation pie chart that I'm quite comfortable with. Of course, a big part of my wealth is still tied down to my home right now, but of course my home is combined with mortgage, so maybe a little bit more than half of it is still in mortgage. That will be my liabilities, and that will be the majority of my liabilities. Other than that, I have a little bit of cash buffer, about 3% of my cash buffer of my wealth. I have a little bit of crypto here, just from a long time ago. But less than 1% of my entire asset is in crypto, and just some of my valuable items, be it my car or my watches, that I just have it as an alternative asset classes. So I encourage you guys to do something like this for you to understand your current financial situation. And and I can share with you guys. This is something that I actively do with my clients as well, through the help of using software, where I also list down with them. This is just a sample, of course, but I list down with them all the investment that they have, what the liability that they have, the asset that they have, so that we can have a very, very clear idea on their current financial situation, and we can track that every year, or do simulation on if they need, do they have sufficient for their retirement. So for example, if we want to simulate they reaching retirement, we can say that if they can live up to age of maybe 85, then we can see from here what are some of the possible shortfalls that they still must continue to save to have a comfortable retirement according to what they have given me. And we can do all this simulation. And this is something that I've done for myself and also for my clients as well, right? But I encourage you to do something similar, to take a look, and you can just need to do it maybe once a year. Just have all your bank statement, all your brokerage statement, and go down to Property Guru and see how much your property is worth right now, taking into account all your liabilities, and you can calculate your net worth. Basically, it's all the asset that you have that you deem valuable, minus off all the liabilities that you currently hold, and that is what we call your net worth. And of course, asset can be anything from cash, your own house, your investment property, if you want to put in your vehicles as well, some of your personal collection maybe that you feel that they are very, very valuable, your stocks and bonds, your funds, your alternative asset. Your liabilities is just anything that you are obligated to repay. Of course, your mortgage, your hire purchase on your car, your credit card loan, if you have some personal or student loans, if you play with margins in your stocks as well, that is also a big part of your liabilities. including some of your tax liability that you know that you would have to pay out over the years. That could be all added up together. At one point, you can decide, when is the right time to do that. Right? You can do it maybe during tax filing season. Since you'll do your tax, then maybe you can do a snapshot on your current situation as well. And once we know how much of your wealth is split from your asset, on where it is allocated, and how much of it is subjected to your liabilities, we can work out your financial risks. So how safe are you in terms of your net worth? In the ideal situation, of course, we want to have as minimum of leverage of debt as possible. And because if you are too highly leveraged, you definitely, personal level, you feel a lot of stress, and that also add a lot of danger into your financial situation as well, because things could change with, last few years, very, very drastic increase of interest rate. We see that the financial burden on a lot of us is increased very significantly. And so having to work towards a key goal, which is to reduce leverage on your life, could actually add and reduce a lot of stress, and also improve a lot of potential freedom for you. Meaning that you can then take your time to weigh your options, right? If you don't have the financial stress to continuously meet your debt obligation, you have the luxury of time and freedom to choose how you want to allocate your money in a more meaningful manner, right? If you are at the situation, right, for example, if you are at the situation right now where you feel that you are quite highly leveraged, that you have a lot of debt that you are servicing, a big part of your income is going towards debt servicing, I will encourage that the first step is actually not to look at investment at all. The first step is actually to look into how to reduce that in a significant manner, to bring that to a more manageable level, like your income, maybe less than 30% should be used to finance the debt. If you're still working, if you're retired, hopefully you have cleared out all your debt, and that will put you in a much comfortable position to think about investing, right? And going back to my example, right? Say if we talk about my key objective right now is really to have a way to grow my wealth consistently and in a comfortable manner that I can still sleep at night. Having financial freedom is very, very important to me. So I'm also looking to ways to pay down my debt as soon as possible, and so that I can feel that has less risk in my financial situation. Apart from that, of course, for my kids and also for my retirement, right? That's some of the key things that is very important for me. And I always feel that when we invest, and a key reason why we invest is to create sufficient wealth buffer so that we can free up our time. And in terms of, if you're talking about our life, I would say that time is actually the most valuable commodity that all of us have. But time is the one that most of us use to trade for money, right? And a key part for me is trying to get out of that situation, to create a portfolio, to reach a point where I have the luxury of time, where I can choose what I want to do with my time. In most situations, right? We can't have 100% all the time, but in most situations, and that will be a financial goal for me. And that's something that I'm working towards. Of course, again, using me as an example, I have to say that I started out at a very, very lucky place. both my parents and my wife's parents are relatively financially stable, and so we never have the stress that of thinking that we need to provide for our parents as they age. They have their own finances in check, and in fact, they are able to provide us with something to get started in life as well, right? But I remember when I first started working close to 20 years ago, my expenses is close to zero because I live at home. I just use my family car. I never go out, so 100% of my expenses, 100% of my income is kept. A similar situation for my wife, and we have a very lucky starting position. But I think that in life, regardless of where you get started, right? Somebody will get started a little bit further up. Some people is less fortunate and has to start a little bit way back. But regardless of where you start, the key is focus on your own situation and just a few key action plan, which is focus on trying to spend less than what you earn, regardless of what that amount is, and just have surplus, right? That's, I think, is the key part where we have to get to the point where we have surplus from our earnings, and so that surplus could be invested as much as possible. And if we have to get into debt, be it for our student loans, for our car, for our houses, one key part is to get out of that debt as soon as possible. The faster we can get out of that, the faster we can increase the momentum of our investment. So that's the backdrop on, I guess, my past 20 years. And this year, my portfolio to 2024, I'm also lucky enough that it has done very, very well. Together with the market, I would say that it's almost quite hard to lose money in 2024. Most market has been up pretty well, including our domestic market as well, both Singapore and also Malaysia, and also around the region. Even China has finally came back this year, one of the top performing market this year, which it has, if you follow the China market, you know that it has been doing very, very, very drastically bad over the past 5-6 years. So almost everyone is up, and my portfolio has been up about 38%. This was done over the weekend, so not entirely the entire year, maybe like the last few days of 2024. But this is what my portfolio looked like when I take the snapshot. Excuse me. So right now I own a lot of stocks in my portfolio. This portfolio, I own close to 40 stocks, including both ETF and also stocks. But I am what I would describe myself as the stock collector. So a lot of time I just buy and buy and buy as I have more and more to invest. I'll just keep buying and buying and buying. I don't really sell for the sake of maybe a stock has become overvalued, but rather I sell for a few reasons. One being if I need the money, or number two, if I need to rebalance my portfolio. So at the end of 2024, my portfolio looks like this, which is about 70% still in US companies, 24% in China and Hong Kong and maybe Taiwan related companies. When I talk about this pie chart, I'm more talking about the exposure that I have rather than where the stock is listed, right? A lot of China stocks are actually listed in the US as well, but I have a breakdown this pie chart based on where the company predominantly do its business. So where am I exposed? Which economy am I exposed to most of the time? So about 70% in the US, about 24% in China, Greater China area, including Taiwan, 3% in Southeast Asia, A big part of it, some of the Singapore stocks that I own for a long time, that I continue to just hold on to them, not much, and also including a company called C Group, right? Shopee, that I have invested in as well. Australia, this is actually just one stock that I own. I bought maybe more than a decade ago on a company called Xero, Xero, which is accounting software company. And I bought it more than a decade ago, and I just kept it ever since. And it has, I think, gone up maybe 30, 40 times that I just kept onto it. And now it's grown to about 2% of my portfolio. And also Europe exposure, very, very little, on about 0.3% there. But some of the top stocks that I still hold in my portfolio today is the list here, where we have Shopify, Alphabet, which is Google, Meta, which is Facebook, Guizhou Maotai, which is a liquor company in China. This is a ETF, the financial ETF in the US. So most of the US financial institution will be here. The Microsoft, Booking.com, which is Agoda, Interactive Broker, and this is a fast food chain, Chipotle Mexican Grill, TSMC, of course, all the chipset manufacturer, Tencent with WeChat, and also MasterCard. These are some of the top ones, I think top 10 that I have in my stock. We can go through a few of them. If you have any question in particular about some of the stocks I own or what, you can always put up the chat box and type in your question there. And also while you're doing that, why don't everyone pull up the chat box and tell me in 2024, what is the most exciting thing that happened to you, or something that you are most proud of that you have done in 2024. I love to hear that from you guys. And we can go through some of the stocks that we are talking about just now. So Shopify, one of my top holdings, is something that I owned for a very, very long time. And in fact, I have already sold down some of it. This was also a stock that I own more than a decade now. And I bought it when it was still at a point where Amazon and Shopify, there still isn't a clear winner whether what form of e-commerce will thrive in the future, of maybe one big supermarket like Amazon, or Shopify, where there's a lot of mini website that's empowered by their own brands. They're using Shopify as the background. So Shopify is basically e-commerce software, but it's just online, and you can customize your e-commerce store with its software. It's one of the most powerful one out there, and a lot of big brands is also using it. Even LVMH, Netflix, they all use a segment of them use Shopify for their e-commerce store. So it has been growing very, very, very well, and it's, I think, from my investment close to more than a decade ago, it has gone up close to 50-60 times of my initial investment. And it reached a point where I sold down half of it to fund my purchase of my home, actually. So this is one that I continue to hold it, even though a lot of period of time it has seemed very overvalued, right? So a key difference of how I invest is I try to be as passive as possible, instead of constantly trying to time the market and sell in and out based on what I think the valuation is. I started out trading a little bit more when I first started, especially before I have kids. And I will do a lot of research on a company. I will track their valuation, and maybe once it reach a point where I feel it's overvalued, I try to sell them away and try to buy other things. But for a long time, after maybe doing that for the first 10 years of my investment journey, I realized that actually there's not too much difference, right? Even adding, maybe double or triple the work of constantly monitoring, my performance didn't really outperform that much, or in some cases, it actually worsened because I make a lot of mistake of selling at the wrong time or buying the next company that didn't turn out to be great. And so I realized that if I really feel that this company is a great company that will continue to be great in my lifetime, I find a point where I bought into them, but I tend to just leave it as it is. And the only reason why I might sell is number one, I need the money, right? And also for another company case, Meta Platform, this is a company that I sold out a portion of it this year as it is rising. I definitely didn't sell at the peak because you can see that close to the end of the year is reaching the peak. But I sold out a part of it mainly because Meta Platform has become too big of a portfolio for my entire wealth. So remember, we have this chart where I show that how much of my entire wealth is in stocks, so about 50%. But Meta Platform itself, before I sold it, it had reached a point that it becomes close to about 20% of my entire stock portfolio. So 20% of my entire stock portfolio, but my stock portfolio is 50% of my entire wealth. It means that close to 10% of my entire wealth is tied to Facebook. Although I still like the company very much, but it's just reached a point where I feel a little bit less comfortable that such a big portion of my wealth is tied to just one company. And especially, I would say, one company that I cannot truly predict what will happen, say, in the next 10, 20 years in the future, right? So that's the reason I sold out of the company. And not because that I no longer like this company, or not because I feel the company is overvalued or in any sense. So I would say that some of my reasoning for selling out of companies might be a little bit not a little bit less orthodontics than less tradition than the traditional mindset of the financial the traditional financial wisdom, right? So, but it works for me, and I think it gives me a much better peace of mind of how I do things. And also, a big part is it helps me cut down on a lot of time that I need to ponder on making this kind of decision. Especially now with kids, with 4 kids, time is really the most limiting factor that I'm trying to find every time, and any way that I can minimize time spent on something, I typically go for the less time option. So that's the reason behind it. Another company, one of the larger ones, is Guizhou Maotai. This is also one company that I own for quite some time. I think this is the one of the only few A shares that I have. I gone through, during the corruption crackdown cycle a few years ago in China. This stock has suffered a little bit, but I have held them through. You can see that even this year, it's not doing that fantastic. I think it dropped about close to less than 10%, but maybe close to 10%. But it's still a great stock that I own. It basically do the most famous China liquor in the world. And their production has been fixed for the next 20 years of how much they want to produce, because it takes a long time to ferment the liquor, and it can only be manufactured in that town. And So I feel that this company is a very, very stable company that has a consistent demand for the next maybe 50 years. So I'm quite comfortable just holding on to this. Next one, this is a fund that I only recently bought this year, which is the State Street Financial Select Spider Fund. And as the name suggests, it buys into the key financial companies in the US. For me, it is a way to diversify my portfolio, which is why I started investing in this ETF, mainly because the S&P 500 is becoming more and more concentrated to tech stock. And I myself is also mainly invested in a lot of tech related companies. So I just want to diversify that a little bit, which is why I started buying into the financial sector of the US as a way to diversify away. And this sector is something that I'm quite optimistic about as well. They have been recovering very, very well since the global financial crisis in 2008. And I see that the financial sector should continue to do very well in the next few years, regardless of how Trump might change the policy. I think it's still going to benefit a lot of the financial sector in the US. And that's why I keep holding it. Next one is also one of the first Chinese related stock that I bought, which is Tencent. This is, to me, this is one of the best companies out there in China. And it is continue to be very, very dominant in the tech space and also the gaming space in China. And so I feel that they have worked out the relationship between the company and the government so far, and they should be able to continue to focus on their business and grow for the long term, and which is why I'm also still holding on to it. And also TSM, of course, TSMC. This is a company I bought a few years ago, but I guess a little bit of lucky strike that it has been tagged on to the AI craze this year and has done tremendous well, about close to double for this year. So a little bit of luck here. But how exactly is this portfolio of 40 stocks and something that I have kept it for the past 15, 16 years? How is this portfolio really formed? And I like to spend a little bit time just to explain the mechanism behind it. I feel that, when we want to start something, the hardest thing is really to get started. And over the past close to 20 years, I see a lot of people come in and out of the stock market. And the key thing is to invest and build wealth in the stock market. You really don't have to be the best. You don't have to always outperform the market or always be smarter than everyone. In fact, you just have to stay in the game longer than everyone else, because the market itself would improve over time, and will do well over time because of all the companies that is tagged onto the market. And the key hurdle for us is really to keep the faith initially, or at least for me in the case, at least the first 12 years. I will say that when I'm investing, the first 12 years, I absolutely see no benefit at all. There's no true benefit that the portfolio brings meaningful return for me, that in monetary sense. Right? It never really is that big of a size of a portfolio that it could reach an amount that I can see that, this is a lifestyle changing amount. Only in recent years, that I start to see and to be able to see the effect of compounding. And that's the reality. When we're building this portfolio, an analogy is, imagine a funnel, right? And we're just trying to pour honey into the funnel to go down. And instead of having a full jug of honey that we can pour all the way down, all we have is a few drops of it every time. And all we can do is really just squeeze that 1 or 2 drop every time, but consistently to the point where the honey is strong, the volume is large enough that it will flow down by itself. Because if you just drop 1 or 2 drop, you realize that honey is very sticky and it just stick on the side of the funnel and it will never reach the bottom. So the only way to let the honey flow is we have to be continuously dripping the honey over and over and over again until it gains to a significant volume that it can flow by itself. And the dripping of honey is equivalent to our savings and putting into our investment account. Only by starting and continuously just putting more and more into this saving investment account to let it do the work to reach a point that we can see that the system is running by itself. And that's really the key. Whereas I would say most of us, when we start, like I said in the beginning, we're mostly on like an experiment stage, right? We try a little bit, and we try it once, and if it fails, we never drop another second drop of honey ever again, right? If it works, we get too excited, maybe we pour the whole jug of what we have, and it backfires, and we again never drip the honey again. The key is actually to consistently drip slowly and slowly to create this habit of building our portfolio. And over time, then we can truly see the results. And this is something very hard to visualize, which is why, again, just now where I share how I can help some of my clients to visualize it is through using my software and letting them understand if we do a monthly constant investment into it, how would that become, right? If we find something that grows at say 12%, if we find something that grows at 10%, if you want to be more conservative, we find something that grows at 6%, how would that differ? How would that change from your invested capital, right? You can see that the projected amount will be different from the invested capital is how much they put in versus what could be the projected value if we continue to achieve that kind of growth rate, right? And that's the key to visualizing the long-term effect of investing. And without that, I think it's very, very hard for us to visualize and to stick to the plan to truly create a portfolio that is meaningful to us, right? So, like I said, the first part is actually to get started, and it doesn't matter where our starting line is. It really doesn't matter. The key is to start where we're at, and because this race of getting towards financial freedom and going towards building wealth is actually a race against ourselves. We shouldn't try to pit ourselves against other people around us. Of course, there's ways that in society there is a tendency and a pressure for all of us to show wealth, even against our peers, even against within our family, to show and show to your parents that you're doing great. But apart from that pressure, the key reason for a lot of us to build wealth is really to have that sense of security that we are we feel safe that nothing bad will really happen to us, that we have more than enough for ourselves if anything bad happens. And that journey is really within ourselves, and that race is really within ourselves. And so the key is to formulate a process to make it into a habit that we can continuously integrate it into our lifestyle and into how we plan our finances. And this is actually a process that I run through with my clients, which is I'll just go through a summary of it, which is a key part is to understand our needs and understand our current status. And the example that I gave just now of just doing the balance sheet of ourselves, just to run through what exactly is our financial status right now. What do we need to worry about? What is the risk of our financial status? How much are we actually paying interest on our debt? And if you have, say for example, if you have credit card debt that is charging you 24% per annum, then the best way is actually not to invest at all. Just pay down your credit card debt. You are saving 24% a year, and 24% a year is a level of investment return that is almost impossible to achieve consistently over time. Even Warren Buffett, for the past, his past 50, 60 years record, he has been growing his wealth at about, I think, 18 to 20%, and he's the best of the best, right? So understand the reality of what investment can give us and what our financial situation is. That is the key starting point. And then from there, we understand and learn and continuously upgrade ourselves to learn what are the available solutions out there. Be it just getting introduced to some of the interesting funds out there, some of the ETF available out there, some of the stocks out there, or any other things if you're interested in property and understanding what exactly could be the range of return that you could possibly get in the long term with each of these asset classes. And then formulating how you want to build your pie that will make you comfortable, that to give you the exposure that you want, but also the comfort that not be too over leveraged and give you stress from your investment, right? Your investment should be there to help you alleviate your stress rather than add more stress to it. So for example, if you really like to invest in property, sure, fine. But should you really leverage as much as possible that you can from the property, just because the bank want to lend you that much? Should you max out your credit every time when you buy a new property, until the point where if you cannot rent out the property, then you feel a tremendous amount of stress that you cannot afford to feed the mortgage? Should that really be the strategy? That's something to think about, right? And then from there, of course, this process of understanding the solution out there is an ongoing process, because there's more and more products coming out every year. And this is a process that we have to continuously educate ourselves or work with a financial advisor to bring us up to date with it. And then from there, we build a solution. How do we want to reach that goal of ours? How much exactly do we need to reach that goal of ours? And that is something that I shared on the other slide just now. On if you have a target return, a target amount that you want at the end of, say, your retirement or your kids' education fund, how much do you actually need to start investing now, say on a monthly basis, on a quarterly basis, to reach that goal, to simulate back to reach that goal? So this is something that is important, I think, to visualize and give us a sense of why we're doing it, because you can never see the result straight away. you're going to see the result 10 years later, or 15 years later. And a key part of understanding why you're doing it and understanding where could be the end point would give us more faith to stick to the program, right? And from there, of course, we implement it, and sticking with the plan. I would say that it depends on how well you know yourself as well. For people, I guess, if for people that you feel that you are self-motivated and self-disciplined, then of course, once you have the plan, it's okay that you hold yourself accountable. If not, maybe you need to work with someone else to keep you accountable, be it your spouse, be it a friend, be it your financial advisor. And that's a big part of my job as well, right? Just once we have a plan of implementing and holding my clients accountable as well, right? To reach that financial goal, to be your personal trainer in your financial health. How do we continue this path for the next 10 years to truly meet what you set out to do? And every now and then, we of course have to monitor and review. Have you changed your the financial status? Have your objective actually changed, right? If you have gotten married or you have another kid coming, maybe your objective is going to change. Or you decided to migrate, maybe your objective is going to change. How would that change the plan? How should you adjust it? Be it to your risk profile, to your investment exposure. That's something that we do on an ongoing basis. And that's basically how I think of my portfolio. And that's basically how I am able to continue that habit for the past 18, 19 years, that constantly, regardless of market up or down, you can see that, this is just my own tracking of how my portfolio is doing. But you can see that there are years that I lost money, and it's very hard to keep the faith, especially when you've done the work for the whole year and you got nothing to show for it. And for some years that it needs a few years before the portfolio recover back to what you experienced in the past. Say, for example, for this period on 2010, after it drops in 2011, 2012, I'm only back to my 2010 level. So for 2 years, my portfolio basically has done nothing. I have nothing to show for it. And to hold that faith that you should continue to just save and put the money into the portfolio, even though your portfolio has done completely nothing, that's something that we have to gain confidence within ourselves that this is the right path, and we should be able to see the light at the end of the tunnel, right? And all this to say is that investing is really scary. It sounds simple, but it's really scary, especially when it comes to our own wealth. And what I'm suggesting is investing should be, to become meaningful, we have to actually invest a big part of our wealth, and that will add to the scary factor, right? But this is also something that in our last webinar we talked about. The issue is we should still invest, because even though it's scary, because the only people that can afford not to invest at all and just put their money in cash are people who already reached their financial goals. They have no more financial goals, right? If you have reached the point where you have more than enough money to spend for your entire life, just keep it in the bank and just spend it, right? And that's why if you still have some financial goals in us, it will be great if we work out a plan to build something towards it. This is a sample of how I do portfolio allocation, right? On what are the market that you want to gain exposure to, and selecting possible investment funds and stocks for my clients. This is just a sample for you guys. And like, if you guys have been following for a long time, you realize that I am an avid believer in ETF, mainly because I think that is the most cost-effective method for us to start investing without a key knowledge of a particular stocks, right? And we can just invest in this ETF that typically will still generate a return in line with the market. And compared to a lot of unit trusts out there, they have much lower fees, sometimes saving you 1 or 2% a year from very similar products. And just 1 or 2% a year, it might sound not a lot, but if we're talking about saving it through the next 10, 20, 30 years, that could really balloon to millions of dollars. This is just an illustration of if you just put in $100,000 today and just a 2% difference in investment return, that could balloon to 2 to 4 million in 30, 40 years. Okay. So hopefully that is something for you guys to think about on if you are thinking of starting 2025 as a clean slate of putting your finances in order. That's the process that I went through, and hopefully you can use it as a reference as well. And bear in mind that all these are based on my philosophy of investing philosophy that I've formed over the past decade, which is always looking at the long term, managing risks, which is most important, which is why I never use margin in my investment, and also just not trying to time the market and keeping calm through market cycles, and building and having a strategy that is everlasting, that I use, something I used 10 years ago, I'm still using today, right? Before we go, I'll just share with you guys our spin-off section, which is I'm going to talk about something that is not investment related, but just something interesting. Over last year, I have started journaling, and I've been using this app called Day One app, and it's just a challenge for myself because I realized that as I get older, I cannot remember a lot of things. And at first, it was just really something to record events that I might forget. So important things that happen, I'll just jot down as point form. But over the last year, I have started using it also as a way to clear my thoughts and also improve my communication skills on how to explain my thoughts a little bit better. Because I realized, especially when I'm talking to my wife, that I have a lot of problem trying to convey what I'm thinking here to what I'm saying out to her and to a lot of people actually, but of course my wife being the main person that I talk to most of the time. And so I guess through the exercise of journaling, it helped me improve my communication on conveying my thoughts and better explain my thoughts out that I'm thinking. So it's just a fun exercise, and I hope that if you are looking for a challenge for 2025, that could be something for you to think about as well. So thank you very much. My name is Stanley again, and I'm a financial advisor for iFAST Global Market, as you know, and I'm attached to the Johor Bahru branch. If you're in Johor Bahru area or in Singapore, our office is actually in Taman Molek. And iFAST is a platform where it allows you to gain access to all financial solutions, and with the help of financial advisor like ourselves for all your financial needs, right? And if what you hear today or from my previous webinar, you want to have a more deeper discussion with me on one-on-one, I do something called a full financial health check with my clients or people who are interested. You can just scan on the QR code or email me or WhatsApp me. These are my numbers, or email me through my contact in learnwithstanley.com, and we can set up a date to do a financial health check and to understand your situation and your challenges that you are facing, and see if we can find a solution for you, right? Before we go, always I like to end with a quote that I found for the week. And today the quote comes from Michael Cunningham, a famous author. And I think this app for today's episode, which is you cannot find peace by avoiding life. And taking control of our finances, I think is can be a very daunting task. It is something that I myself working in the finance life have avoided for a long time of not truly finding the time to see the entire picture of where I stood financially. But like what he says, you cannot find peace by avoiding life. This is part of life. Having the financial resources we need is part of life, and to have a successful life. And so the only way is to face it, regardless of how messy or how difficult you might think it is. But once you get started, you'll realize that it's never as hard as you think it is, and is definitely very, very achievable for most of us. So thank you once again. I really appreciate you guys spending this hour with me. My name is Stanley, and Happy New Year. Until we meet again, invest safely. Bye bye.